Hi everyone, this is the 30th of January 2018 and it's been a pretty long time since my last video update. It's been a pretty busy month with so many markets moving, and I've been writing about all of them every day, and some of the major macro moves have essentially kept my attention. But it was also an interesting month because starting from the 17th of January, we've seen this big blow-off move in the index. Now, just around then, I released the long-short report because we'd reached some extreme sentiment readings. We also hitting the trend line of the highs of the two previous tops that occurred in August and in the month of November. And when we stretch that trend line, and if we used an arithmetic scale channel line, both of them were converging near the 10,700 mark, and so that became the objective that I set out at the end of December. And as we got closer to that point, I thought that those extreme readings, very similar to many other immediate tops that we'd seen recently, would probably work at that level. And what we have seen is that it has actually worked for the broad market, which means that you've actually seen stocks selling off from the third week of January itself, which means the mid-cap indices are actually down since then. The small cap index is now in its third week of decline, as it actually broke the previous week's swing low, and which is why this was a very, very interesting time, because you got this massive divergence between stocks and the Nifty itself. Now, typically such divergences, intermarket divergences, mark coming market reversals, but you have to actually wait for the reversal itself to happen. At the same time, the knowledge of that, if you're on a stock portfolio, should allow you to trail and exit stocks that are actually not performing or actually hitting your key reversal levels. So I think it clearly provided a guideline for that to be done, because if you are on a portfolio and if you're long, it's possible that in most cases people are actually losing money. This is a discussion I was having with my business development head just this evening, and that's the case they're facing with a lot of customers, where the markets actually rallied and portfolios are actually down in value, and especially people who have trading positions in the futures market are facing M2M losses despite of that, which is why you note that I made the stock section of the site open for a while, and you see a lot of the ideas on the sell side. So I always highlight stocks that are showing weakness. We don't really put out any advice. So when I say sell side, essentially mean that momentum indicators are trending down either on the daily, weekly or monthly time frames, which means that there's a lot of weakness in so many spaces. So even in the PMS that I handle, which is a long short portfolio, the Nifty has essentially been long for most of January. Since late December's buy signal on the index fund, it just remained long throughout this period. But on stocks, we've essentially been meaningfully short, few longs in between, but mostly short, and in sectors which are weak, like public sector banks, for example, which I keep talking about. So that's how it's been. You could be long or short anything. When it comes to my analysts, I tell them always prepare two lists based on what market direction you want to take. You always keep a list of strong market performers, those which are outperforming, and a list of those which are the weak stocks. So if you feel bearish, you short the weak stocks. If you feel bullish, you buy the strong stocks, and they're completely two separate lists that you have running. The only thing is that the number of weak stocks has just increased exponentially. You've got one of the best performing sectors like the housing finance lot or the NBFCs actually underperforming now, which were earlier performers. So we've seen this sector rotation, and the private banks, which had become the weakest like Axis and ICICI, actually are outperforming for a while recently, including the tech stocks, which surprised me because I thought the 2015 top was a top for the tech sector and it was underperforming for most of these 2.5 years. But in the last 1 month, they have given you a surprise rally, and the IT index actually made one more new high. So that's what has been happening, and what really triggered that move beyond 10,700 was an amazing amount of rumors, or should I say fake news, because it started off with this news item which was floating all over the internet, essentially on the expectation of FDI limits being raised for the banking sector, which was later denied. And if it was denied, then was that news really false to start with? And ideally the media that is put it out should have at least come out and said that they were falsely informed. So that's unfortunate. These things don't get investigated, but essentially when markets turn bad, then everything gets investigated. So that's how it's always been. Scams and scandals continue in the background only till things get really out of hand, and only when there's a crisis do they get investigated. So that's always going to be the case, but that news item created a lot of rumors all night long and led to a gap up opening on the following day of almost 200-300 points on the Sensex and almost 50 to 80 points on the Nifty, and then that trend continued once it broke past the 10,700 mark, beyond the 11,000 mark. So I've moved from looking at a log scale to an arithmetic scale, and the same channel that I was drawing earlier on the arithmetic scale, if drawn on a log scale, stretches all the way to 11,500, which leaves some room open on the upside. But we've got this intermarket divergence with the mid caps, which continues to be a warning. So from that time period, the broad market essentially kept giving up. But the rise in Nifty led to the market-wide sentiment indicators, essentially put call ratios, the net put open interest hitting new records. In fact, the net open interest from the put side, which means the amount of puts that was sold relative to calls, in actual value terms, hit the highest on record. So the last record was at around 40,000 crores, which was reached in July, and the following month, August, we actually saw a correction. Prior to that, the last record was around, I think, 38,000 or 39,000, which was reached in Jan of 2015, just before we hit the 9,000 mark, and then we made a double top near that up to the budget in March, and then sold off from there. So, but then those highs were essentially marked the high for that year. So that's what I thought would happen after August and September, because we'd already done, over 40,000 crores of net put selling at that time, reached a sentiment extreme, but that pattern continued to extend itself, and in January we crossed that and we almost hit the 50,000 mark. I think 51,000 was recorded on expiration day. The net put side open interest, which was left open and closed out, which means that's the size of extreme bullishness that was displayed by the option sellers. But the volume put call ratio essentially was not that high. So while you'd think that somebody also bought a lot of puts, which is definitely true, it was not based on panic. So it was essentially more of selling than really buying that would have really pushed up the volume of puts being traded, which was not the case. So you have had that extreme. You've had the PCR shoot up. You now have post expiration. Just yesterday I put out a chart. FII long positions, which is the total of futures and options contracts put together, actually shot up beyond the highs that they were making for the last 2 years, because right on expiration day, the futures position of FIIs had actually been gone from zero to even negative in the last 1 week prior to expiration, even as the market was going up. Typically when it goes up, you see long positions build up on the FI side and client positions go short. We had the exact opposite trends, wherein FIs were on the net short side and clients' positions were on the long side. Even though on the option side, FIs did not really have much of put options, which is why their total position was still long, but it was not above the highs that they had made, where various tops had occurred over the last 2 years. But that's what has happened post expiration, because now they're long almost 107 to 109,000 Nifty contracts as of yesterday. And when you add that up and I plot it as a percentage, then we've now gone past those highs that we'd made for the last 2 years, and the last previous highest reading in percentage terms was around a 29% long position, and that was seen in 2015, before the March 2015 top that we saw back then. So we are now at around 21% yesterday. Still to look at today's end of day data, and it could move up or down, but essentially we would be moving. We could actually move higher and see and test the 25% mark or higher before you see a final high. But now that these readings are above the last 2-3 years, it fits what we would call an extreme sentiment reading in terms of the bullish sentiment being displayed by FII positions across futures and options. So many indications that show that you're into an exhaustion rally. In Elliott wave sense, we usually look for a triangle in the fourth wave, and then the fifth wave blows off. We had a triangle between November and December in most indices, Sensex, Nifty, mid cap, small cap. And so clearly this was a blow off rally that had to terminate somewhere. It probably terminated for the mid caps and small caps if they don't recover to new highs and continue to head lower for this week. Most probably they've already peaked. What we haven't got yet is a final peak in the Nifty and Sensex itself. So those remain lagging behind, but eventually they would catch up at some point of time is what I sense, whether before or after the budget. The budgets have marked many highs and lows for the market. In fact, most of the 90s, they used to be an important high-low period. And in fact, over the last 2 years, we've seen many tops and bottoms occur around budget time in 2015 and 2016. And so it was the in-between period, I think, between 2002 to 2013, that we shifted away from that cycle as we became part of the global markets, where we more often saw January tops or late mid-Feb tops rather than on budget day itself. And so the significance of the budget day itself in terms of marking a high or low had meaningfully gone away. Also, the prior government had made it amply clear that they would not be doing any kind of reform-related measures in the budget, and it would be more an account statement and probably some changes in taxes, and which is why the relevance of looking forward to the budget from a reforms perspective was gone. But given the weakness in the economy, people now continue to look for budget for some kind of spending pattern to be able to identify that the growth momentum, especially from consumer-based spending or some other form of stimulus, continues to push up the economy. And I think that's the key point that we would look for in this budget, apart from that the speculation that there would be something on taxes post what the US has done. But my sense is I unlikely to see any kind of major tax changes. Maybe we would hope that there would be some reforms in the way taxes are calculated. You have so many slabs and multiple surcharges. If you could just combine them into something simple. But then a lot of these things are done for political gains, and therefore you have names like Swachh Bharat tax that provide an identity to actions that the government is taking. So it's more a branding exercise than anything else. So I wonder whether they would do away with it, but that's what you'd hope for. And last year, in the name of bringing the corporate tax rate down to 25%, the government already announced multiple taxes for new businesses and startups and so on. That I really wonder whether they would be looking at bringing down the real corporate tax rate anywhere down to that number, the way the US has already done. And we also have major issues on the fiscal side, which means every year we have to sell some amount of public sector assets to really make up for the fiscal deficit and to maintain the trend of a lower and lower fiscal deficit as per the long-term target. And for that reason, giving away tax receipts does not essentially look like a potential option. But then of course anything is possible. It's not that they can't do it, but it looks less likely given the path that we've taken so far. So that's a lot of what happened. Apart from that, we had this meaningful news, the second news event that affected markets last week, and also in October, was that related to the public sector banks. Now essentially I've been negative on that sector for pretty long, and for the very reason that you may or may not have taken note what was announced last week, and if you didn't, then here's what it is. I think the high that we saw in October when the announcement was made has still not been surpassed. In fact, we've been trending down since there. And at that point of time, they didn't divulge the details of how they would be giving away that money. And now they've at least front-loaded the banking sector with it. But what the main concern that I was highlighting for most of the last 2 years was that the entire restructuring of these banks would involve dilution of their equity, and that's why the stock prices would actually plunge. And the dilution phase has actually just begun. What they've done in last week's announcement is essentially announce the amount of money that they're giving banks by, of course, borrowing it from them in the first place, but that money would be given back to them over a period of time. But that said, in the immediate term, it means that cash is being deployed as capital, and so the cash would not be there with the bank. So that's not essentially good, because they would still need money for fresh loans. And on the other hand, when the government gives that money back to the banks as capital, they essentially increasing their equity, and in some cases the equity increases at as much as 100%, which means the equity capital just doubles. In some cases it goes up 30%, somewhere 50%, depending on bank to bank. So the amazing cases where you would see, the companies which are not under the PCA, which is the where they've not come under scrutiny for not recovering loans, they've been giving bigger amounts, but their dilutions are also much bigger. If you just look at Bank of India, so it was given one of the biggest amounts, but its equity capital dilution is also very huge, which is why it was one of the weakest performers right after the news was announced. So people don't get that. They probably look at the numbers of, it's got so much of money, it must be a good stock, and it actually shoots up. But really what must be happening is people who are looking at selling or even shorting, big players may actually be pulling it up simply to sell more into that move up. So if you don't understand how balance sheets operate, that if you just increase the capital, the valuation essentially goes down, and that should be obvious to anybody who knows a little bit of capital markets. If you know that, say, if Reliance Industries tomorrow says that we are going to raise 50,000 crores of new capital, is the stock price going to go up or going to go down? Because if you dilute the entire equity, the size of equity capital goes up, the EPS goes down, the book value goes down. And so this is just the first round of this being done for public sector banks for some of the losses that they've provided for so far, which is just a percentage of the NPAs that they have on their books, which are not recoverable, and there's a lot more NPAs waiting on the sidelines to even get recognized. This is a process that will go on for a long period of time, and the onus has been put on the banks to essentially raise more of the capital that they need for moving ahead with their business. So they've been provided some capital so that they can remain functional. They've been told to start recovering those loans, and at the same time they need to go back to the market and ask for more money. Does not sound an easy task, and at the same time very clearly means more dilutions are coming on the way. And so there's no way I can see logically that these PSU banks are anywhere close to being value buys till this process is complete. That said, from a pure technical Elliott wave perspective, I've posted those posts saying that I think in October itself I mentioned wave Z, the final wave down for the sector is essentially to start, and I think it's already underway. And this is probably the last phase, but we don't know what the size of this phase will be, which is why you need to let it play out before you really take a call, that the worst is over. But yes, every time the name of this sector is flashed all over news channels, these stocks tend to shoot up for the day, and it's essentially a false buying signal that is taken up by many people as maybe there's a value buy. But if you just look at what is really happening to the balance sheets and the level of NPAs that are still waiting to be taken care of, nowhere close to the end game as yet, as far as that is concerned. So take that news very, very lightly, but it created a lot of enthusiasm. The good news is it's done with, it's already announced, and there's nothing likely to be said about it in the budget. So no more news on the PSU bank related issues in the budget. You'll be looking more at tax related discussions happening out there, and hopefully reforms in other areas of the economy that need to be addressed. Maybe something new that we don't expect is announced, and hopefully not too much of spending in terms of wasteful expenditure. But you don't know, you're going to be entering an election year. We don't know what kind of spending patterns will be taken up over the next 2 years. The reforms that have been done so far are great for the long-term good, there's no doubt about that. But how do we get sustained growth cycle revival? If I just go by the economic survey, it seems to be completely depending on the fact that US is growing and it will somehow manage to tag us along, something that it has not managed to do this far. So I definitely feel that there's a need for an additional stimulative impact from the government side to really get growth back on track, purely depending on world growth, driving us along might not be the best recipe, simply because most of them are, and especially the US, is too busy taking care of its own problems than to try and drag everyone along with itself. And slowly and but not surely, they are moving towards doing more and more business internally, which is why they came up with these big tax breaks, and they're looking at finding ways to employ people domestically, then outsource everything that you would want in terms of business moving outside of the United States. So, which is why you have the big macro trend, which is the dollar, and I've spoken and written about that over and over. And while people have not believed, we've already fallen below the 90 mark. And as the dollar index continues to fall, there will be a trigger point at which foreign investors, who've been the biggest reason why the dollar rallied between the 2014-2015, that moved money out from weaker areas like Europe, China, where there were various issues at that point of time, and bought into US bonds or real estate. They will hit their panic buttons when the dollar index continues to fall beyond the point and hurts those portfolios. And I think the most immediate impact occurs on the bond market, because while equities have been going up on a relative basis, you can still say that equities are beating the dollar. But in terms of the bond market, you can definitely not say that. The losses are coming from both the sell-off in the bond market because equities are going up and the falling dollar. So there's a dual impact which will put pressure on foreign investors who actually move out or keep moving out of the bond market. So the bond market decline is something that's going to be a macro trend that's been there all of last year. And you'd think, I would have thought it would have had a market impact much earlier. It's still not had that. Even though we are already into the third wave of the sell-off, and usually in the third wave is when most of the damage is done, and this third wave is in continuation now. So 2018, I think definitely will see that damage coming at some point of time, and you need to be extremely alert as to when that starts happening. And it has a very direct impact on interest rate sensitive stocks, which is essentially financials. It could include auto stocks. You're already seeing that in NBFCs and housing finance companies, which are already weak for various other reasons as well. So interest rate sensitives, I guess, are the area to be the most careful of in the environment where you're going to continue to see rising bond yields, and simultaneously also seeing inflationary pressures, because you've seen a powerful commodity rally on the back of the falling dollar. And these are trends that are likely to be multi-year in my view, because the dollar itself follows cycles, and you've seen 9-year bull markets and 7-year bear markets in the dollar, and we are now into the second year of a dollar bear market. So you'll at least have another 6 years to go as far as that is concerned. So long update, long time. I hope to do it more often, but that's all for me for today. Thank you.